everyone, and the month of May was no exception to this rule. In May 2023, the large cap Nifty index has moved up by over 3%, while the mid-cap and small-cap indices outperformed the Nifty index during the month. However, while May has seen equity markets move up, Indian equities, which outperformed emerging markets in CY22, have underperformed its emerging markets peers in this calendar year. In terms of flows, data till May 29 shows that foreign institutional investors who have been net sellers of Indian equities calendar year to date turned net buyers during the month to the tune of over $4 billion. Domestic institutional investors were marginally net sellers, even while on a CYTD basis, they have been net buyers. Now, from a macro standpoint, the big question remains, is the world likely to face recession? The probability of recession in developed markets remains high. The US CPI inflation has eased, but core inflation remains sticky, and the US Federal Reserve is walking a tightrope trying to maintain a balance between slowing growth and sticky core inflation, given that labor markets in the US still remain tight. India continues to be an oasis in the global context, with the economy being much better placed in terms of most macroeconomic parameters, whether it be growth, inflation, and monetary policy. Most of the high-frequency economic indicators remain strong. For example, GST collections at over 1.5 trillion rupees per month appears to be the new normal. Further, for India, shrinking current account deficit, led by improving terms of trade and rising forex reserves, has also led to reduction in vulnerabilities, especially in the external sector. India's services exports surpassed pandemic era high, and services exports as a percentage of GDP stands at 9.9% in the October-December 22 period. Now, while the US and European banking system vulnerabilities were brought to light with the failure of a few banks, the Indian banking system remains on a strong footing. Indian banks are well capitalized, have capital adequacy ratios much in excess of regulatory requirements, and have healthy balance sheets. Credit growth remains buoyant and broad-based, while asset quality trends are benign. The one big question for India in everyone's mind is whether monsoons will be normal this year. El Nino risks are rising. And in fact, the IMD updated its forecast for the upcoming monsoon season. Now, while they have maintained its earlier forecast that rainfalls will be normal, they did have some additional caveats, especially around El Nino, and maybe a weak start with below normal rainfall in June. However, the impact of monsoon depends not only on the quantum, but also the spatial distribution of rains. Further, steady gains have been made in irrigation over the years, and one must remember that today the rural economy is not only agriculture, with the rest of the economy being supported by infrastructure development. Rural infra improvements often help soften the blow, especially in bad years where agri is concerned. Now let's turn to earnings, and we are now close to the end of the Q4 FY23 earnings season. 48 of 50 Nifty companies have reported as we speak, and earnings have been largely in line with estimates at a headline level. Nifty companies have reported a 13% year-on-year revenue growth and a PAT growth of almost 16% year-on-year. Margins for most companies have started improving on a sequential basis, with commodity costs having corrected sharply. Most of the earnings growth have been driven by domestic sectors such as banking and automobiles, while metals have been a drag. As a consequence, earnings estimates for Nifty companies for FY24 have not seen much cuts over the past few months. FY24 consensus earnings estimate remains in the mid to high teens. We would also, however, need to watch out for earnings revision at a broader market level. At a broader market level, there have been wide dispersion between stocks and sectors in terms of earnings, and therefore it's important to look at stocks where earnings visibility is clear or growth potential is evident. Now let us turn to valuations. Absolute valuations for Indian equities has corrected closer to long-term averages. India's premium to peers has also corrected and is now closer to long-term averages. However, relative valuations of mid-caps to large caps still remains above averages, although market valuations are in fair zone now. In this sort of a context, earnings delivery becomes crucial for market returns from here on. Our recommendation is to stay neutral in equities in the asset allocation basket. It is a buy on dips market and therefore use every correction as an opportunity to increase allocation to equities. We continue to be marginally overweight on large caps and marginally underweight mid and small caps. Overall, we are more stock specific in portfolio construct, focusing largely on sectors which are domestic facing in nature. From a bottom-up basis, we are focusing on high-quality names which have corrected meaningfully, where growth expectations have not waned and earnings visibility is there. We have been positive on domestic-facing sectors. Clearly, domestic growth remains more resilient than global growth. Banking remains one of our top sectors across portfolios. We have seen credit growth improving, asset quality issues have subsided. We are also positive on few other domestic businesses such as industrials, capital goods, infrastructure, auto and cement. We are cautious on global facing sectors such as metals and IT. In conclusion, we would encourage investors to continue with a disciplined approach to investing, focusing on long-term goals and asset allocation strategies. Stay safe, stay invested. Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.